As the long-term oil demand growth outlook increasingly comes into question, why would oil companies allocate more capital toward higher-cost U.S. shale? Hi, I'm Mark Laskin from Recurrent Advisors, looking at the evolution away from cost as the sole variable to allocate capital within the energy industry. As we described in our dispatch curve white paper several years ago, over the last 10 years, U.S. shale has served as the global oil market's balancing mechanism or peaker plant. This framework, based solely on production cost, proved valuable during demand growth periods when U.S. shale grew production by 1 million barrels per day and decreased production by 3 million barrels per day in the earliest stages of COVID. With the increasing perceived risks of ESG and the energy transition, a new paradigm is unfolding. The risk premium for oil projects is rising, and as a result, an additional decision variable is increasing in importance: time. U.S. shale, with its uniquely fast payback period measured in months, will increasingly become favored relative to the longer duration offshore projects which are measured in decades. Over time, there will be less risk of multi-decade inelastic offshore projects, and instead, the global oil market will increasingly depend on higher cost but shorter duration U.S. shale wells, which require higher maintenance capex in order to maintain supply. If this interests you, please go to the thought leadership page on our website, www.recurrentadvisors.com, where we discuss this and many other topics.